In June 2002, one of the 5 most powerful accounting firms on Earth was convicted of a federal crime and destroyed. The firm had 85,000 employees and nearly a century of history. It collapsed in the 89 days between its federal indictment in March and its criminal conviction in June. A single client killed Arthur Andersen. One engagement and a series of decisions made in a Houston office turned the world's most trusted auditor into a criminal defendant. Understanding how Enron could liquidate a global giant requires looking at what the firm stood for before it became collateral damage. Arthur Andersen founded his firm in 1913 on the principle of telling the truth regardless of the cost. He called it thinking straight and talking straight. In the early 20th century, the firm's core commodity was trust. As these banners suggest, having Andersen's name on a financial statement served as a guarantee to investors that the numbers were honest. The firm built this reputation by aggressively challenging corrupt executives. Andersen partners frequently walked away from lucrative accounts when clients refused to comply with accounting standards. Because integrity was the source of their entire market value, the firm's eventual demise began as a quiet internal erosion of that identity. During the 1990s, the accounting industry shifted toward a more profitable model, consulting. Firms began earning more for advising clients than for auditing them. This chart of the Enron account in 2000 reveals the conflict. Andersen's Houston office collected $25 million to audit Enron's books, but $27 million to advise them on business strategy. David Duncan, the lead partner on the Enron account, sat at the center of this financial tension. His career success was tied to 20% annual revenue growth. He was financially incentivized to keep the client satisfied, despite questionable accounting. This fee structure turned the independent auditor into a dependent salesman, making the firm's survival contingent on Enron's approval. Beneath Enron's corporate facade was a machine designed to hide massive debt through fake reported profits. Carl Bass, an internal expert at Andersen, flagged these fraudulent structures. When Enron executives complained, Andersen leadership simply removed Bass from the account to protect the relationship. Even when Sharon Watkins' warnings about the fraud reached Andersen's partners, the firm maintained its silence. Silencing their own experts to protect the Enron fee marked the moment Andersen's culture officially failed. In October 2001, Enron collapsed. As the SEC requested audit documents, the Andersen Houston office entered a state of emergency. David Duncan ordered a massive document destruction campaign. His team began shredding Enron-related papers before a formal subpoena could reach them. Over 17 days, the office destroyed truckloads of physical records and purged thousands of digital files. This destruction of evidence gave federal prosecutors the grounds they needed to charge a 90-year-old firm with obstruction of justice. On March 14, 2002, the United States Department of Justice indicted Arthur Andersen. In the accounting business, an indictment is a death sentence. Major corporations like FedEx and Merck fled immediately, unwilling to associate their financial statements with a firm under criminal investigation. By August, 85,000 employees globally were out of work. Decision-making in a single office had liquidated the careers of thousands of people who had never even seen an Enron document. A firm built on trust cannot survive the loss of its reputation. The market executed Andersen long before the jury finished deliberations. In 2005, the United States Supreme Court reviewed the case and reversed Andersen's conviction in a unanimous 9-0 vote. The court found the original jury instructions were too broad, failing to distinguish between criminal obstruction and the firm's routine document retention policies. Technically, Arthur Andersen was innocent of the crime that destroyed it, but the ruling arrived 3 years too late. The firm was already gone. Cultural drift killed Arthur Andersen years before the first document reached a shredder. This collapse led directly to the Sarbanes-Oxley Act, which permanently banned audit firms from providing the high-priced consulting services that had poisoned the Andersen-Enron relationship. Compromising independence to protect a client's revenue creates a debt that eventually comes due. For Arthur Andersen, that cost was everything.